Hello everyone, welcome back to the This Time YouTube channel. This is Stock Market Weekly Update. The stock market bounced back this week after a slight pullback. The wholesale price index reached a new all-time high, closing at 21,085 points, up by 473 points. That's a 2.3% gain from the previous week. The S&P SL20 also moved higher, adding 118 points to the close at 5,996. On the foreign investor side, activity remained strong, but the balance tilted towards outflows. Foreign purchases totaled about 534 million rupees, while sales were much higher at 1.8 billion rupees, resulting in a net outflow around 1.3 billion rupees for the week. Meanwhile, there was a major credit development. S&P Global Ratings upgraded Sri Lanka's long and short-term foreign currency sovereign credit rating to CCC Plus and C from SD, while affirming this CCC Plus and C rating on local currency debts. It will be interesting to watch how the market reacts to this credit rating improvement in upcoming weeks. In our last video, we explored how investors can diversify their portfolios across different asset classes, geographic regions, and industries to better manage risk. Equities, in particular, offer a powerful way to achieve diversification, as they allow investors to spread their investment across multiple sectors. On the Colombo Stock Exchange, there are 286 listed companies categorized under 11 industries according to the Global Industry Classification Standard. This sectorial breakdown provides investors with the opportunity to reduce concentration risk by allocating capital across industries such as banking, manufacturing, energy, consumer staples, and more. Therefore, an investor aiming to build a well-balanced portfolio on the CSE could strategically diversify their holdings across all 11 sectors, leveraging breadth of listed companies to enhance both stability and long-term growth potential. Let's take a quick look at the Global Industry Classification Standard, or GICS. GICS is basically a system that helps investors understand what a company actually does by grouping businesses into industries and sectors. It was developed by MSCI and Standards and Poor's, two of the biggest names in global financial data and indices. The framework has four levels: sectors, the broadest categories like financials or energy; industry groups, industries, sub-industries, the most detailed level. Each company is placed into just one category at each level, based on the main business activity. Most of the time, revenue decide this, but things like earnings and market perception are also taken into account. The system is reviewed every year to make sure it reflects real-world market changes. So, why does this matter to investors? Because GICS gives everyone a common language, whether you are looking at banks in Sri Lanka, tech companies in US, or energy firms in Middle East. GICS make easy to compare them under the same standard. This helps with diversifying portfolios, spotting sector trends, benchmarking performance. In short, GICS makes analyzing industries and managing investment a lot clearer and more consistent worldwide. How to minimize risk by diversifying through global industry classification standards. Step number 1. Understand the GICS framework. GICS, or Global Industry Classification Standard, organizes companies into 11 main sectors such as financials, energy, consumer staples, industrials, healthcare, and information technology. This framework gives you a clear map of where each company belongs. Step number 2. Analyze the sectors on CSE. On the Colombo Stock Exchange, there are 286 companies listed across these 11 GICS industries. Review how each sector is performing and consider long-term trends like growth in IT, steady demand in consumer staples, or expansion in financial services. Step number 3, spread your investments. Instead of putting most of your money into just one or two sectors, spread your investment across several. For example, you could allocate a portion into financial, another into energy, and another into consumer staples. This way, poor performance in one area can be balanced by gain in another. Step number 4, balance growth and stability. Mix high growth sectors like banks and telco with defensive sectors like healthcare and consumer staples. This balance helps reduce volatility and gives you portfolio both protection and growth potential. Step number 5, review and rebalance regularly. Diversification isn't a one-time decision. Keep reviewing your portfolio at least quarterly to adjust your allocations based on market performance, sector outlooks, and your own financial goals. Let's look at the sector-wise performance of last two quarters. In quarter 1 2025, the sector-wise performance on the Colombo Stock Exchange reflected a mixed picture. The table highlights each industry as classified under the Global Industry Classification Standards, showing the opening index value, closing index value, and percentage change during the period. Out of all industries, 10 sectors recorded positive growth, while the remaining sectors struggled with declines. In quarter 2 2025, the trend improved further with the exception of consumer services, household and personal products, and software services. All other industries reported growth compared to quarter 1. This indicates that while some areas of the market remain under pressure, the broader recovery momentum is visible across most sectors. A closer look at data shows that growth and decline vary by industry, reflecting the influence of multiple factors, ranging from economic conditions and consumer demand to market sentiment and global development. For instance, when the Trump administration announced reciprocal tariffs, industries such as consumer durables, apparels, food and beverages were directly affected, leading to a negative impact on their respective indices. The fluctuation underscores the importance of diversification. By maintaining a well-balanced portfolio that spans across multiple sectors, investors can reduce exposure to risk concentrated in any single industry. This strategy not only minimizes downside risk but also ensures the participation in upside of growing sectors, helping stabilize long-term returns. That's a quick look at how the Global Industry Classification Standard can help you diversify your investment more effectively. If you learned something valuable from this episode, drop a comment below and share what classes of asset you include in your own portfolio. And remember, always invest carefully and be sure to do your own research before making any financial decisions. That's it from this time for today. If you found value in this video, don't forget to like, subscribe, and hit the notification bell so you won't miss our upcoming market updates and insights. Thank you for watching, and we'll see you in the next one.